If you bought this hotel today at 10 million shillings, and the annual revenue is 1 million net revenue, how long would it take you to recover your money? Talk to me, guys. 10 years, that's a P ratio. That's a P ratio. If I bought ABSA Kenya today, and their net revenue, if I bought ABSA for 100 billion today, and their annual net revenue is 10 billion, how long would it take me using what is called trading PE, the most recent trading PE, ile iko washatagaza tuseme ni 10. How long will it take me to recover my money that I invested in ABSA? That's what is called PE, price over earning ratio, or market cap over net earnings. It will give you the same. If you bought all the companies listed in the US, their PE ratio is 27. It will take you 27 years. There are some that are low, but there are some that are people are buying future. Take Tesla. Tesla is over 200 PE ratio. Most tech companies have higher PE ratios because you're buying the future more than the present. JSC Johannesburg is around 17, maybe 15 to 17. Nigeria around 11. Kenya, the average PE ratio in the Kenyan companies is 5. So I'm starting here as a very patriotic Kenyan, that in the current moment, I don't know why I should not buy shares in Kenya. And I have no reason to buy in any other market. And I have actually no reason to care about what the government is doing, because some of the companies are too solid for any government to do anything. That's why in this period, since you started hearing me talking about these issues, I don't know any market in the world better than a Kenyan market. None. I don't know any. And I'll give you homework. This is the last thing I'm doing, then I keep quiet. Take your phones, your smartphones. AI will do this for you. Namaliza sasa. Namaliza. Can I get volunteers, 4 of them, just 4, so that this presentation is not mine alone. Just 4. Hata tunamaliza. 4 people with phones to come. Yes, Basaria come. Yes, please come. Tutukuje hapa. And ladies, 2 ladies now, 2 bars now. Kujeni. And as they come, my school of thought is this. I said, if you have listened to so many things from morning, my school of thought is, Mimi, in terms of investing, I either invest to get rich or I don't invest. So I'm just saying, in the risk profile, don't grade me at the age of my father. My risk profile must be higher. So it's either I am putting in money, I get rich, or wacha nikae nayo. So if you start telling me you have $1 million, I put in somewhere to give me at the end of the year 20%. So I have $1 million, so you give me 1.2 million. So I have 100,000. You are promising me after a year to give me 120,000. So what goes in my mind is this. So I already looked for the million without knowing you. You are helping me make 120,000, then I don't need to know you. So my school of thought is that I put in $1 million, I talk about multiples, ama nikae nayo. Is that the investment changes my life, or I don't do it? Maybe it's about my age, maybe about my risk profile, maybe about my exposure to many instruments. I don't know the reason. Okay, there is a thin line between getting multiples. There is also the downside. But for me, I would rather handle that than handling at an assurance. Umeinvest $1 million, mtu anakupromise at 200,000. How a person having $1 million, what will 200,000 do to you? It means if you are in a rental house, paying 100,000, somebody is telling you to move. So you know investment and money should, in quotes, make our standards of life higher. So let's take where you live as the standard of life. So you pay 50,000, somebody is telling you to work so hard by investing so that you move from a house of 50,000 to one of 60,000. What is the difference between a house of 50,000 and 60,000? You not even move the estate. Even the flat, your next door neighbor will be paying 60,000. Actually, when you move and return in the same house, you realize they were waiting for you to move so that they increase the rent. So it's not changing your life. So it's either you are moving from a house you are paying 50,000 to one of 150, ama ukae ile iko, ujipange vizuri. That's my investment reasoning. Take your phone. You'll do for me Standard Chartered Bank. Whatever thing I'm going to ask, Standard Chartered Bank. My brother will do for me Equity Bank. My brother will do for me, let me diversify from banking. I'm looking for listed companies. Do for me Car and General. Car and General. Have you ever heard of Car and General? Very good. There is a talk I had in the UK earlier this year. Then somebody asked, if you had 20 million, where would you invest? Then I mentioned Car and General that time. It was earlier in the year. Then I saw people looking at each other. That time it was 45 shillings in the market. I don't know what it is now, you'll check. You'll do for me, Kenya Power. Now, AI will do for you. So you just Google. Don't even do anything. I want you to check for me, what is the PE ratio of all those companies I mentioned, according to the one you're handling. What is the PE ratio of? Then you look at the company we talked about. We'll be starting here. So that, ukikogo to AI itakupea. What is the PE ratio of Standard Chartered Kenya? Remember to put Kenya because Standard Chartered is global. Yes, maybe that's why it's confusing you. This is important. I know you know it's important, the people in this hall. Because it summarizes a lot of things. To me, as an individual investor, PE ratio summarizes a lot of information about the company. And the beauty, it does not communicate to me the hope. It communicates to me the current situation. Can we start? Inakuletea shida? Let's start from here. And you mentioned the company because I'm writing, and you write the P, and you mentioned the P ratio.
It's saying between 2021 to 2025, the ratio is 10%.
It's 10. Actually, it's not percent. P measures periods. 10. P measures years. I hope you understand, but you got it right. It's close to there, I think.
Standard Chartered.
Standard Kenya. Yes. Let's go.
So it says the current price to earnings ratio for equity group holdings is approximately 3.8.
I know you think he's wrong, but he's not wrong. It is true. Because you have a company is now valued in the market at 270 approximately billion, and they are making 75.5 billion in net profits. Without accounting for, using the first quarter, they've already started again reporting increment in profits. So I'm actually using trading P. I'm using trading PE. If I use forward PE, let's go.
Car and General PE ratio 2.6.
I also think most of you think he's wrong. He's not. A company valued at 6 billion, and they reported, I think, over 2 billion in net profit. You are buying a flat, in the case of Equity, you are buying a flat for 27 million shillings. But the net, after umelipa caretaker, the net rent per year is 7.5 million. That's the case of Equity. I'm just removed the zeros. Let me repeat. You are going to take 3.7 years to recover your money using trading PE. Let's go to the last one.
KPLC, Kenya Power, trailing PE is 1.45.
I think you can clap for the lady, even for saying that. Even for saying that. No, good Kenyans. Let's be actual here as Kenyans. Just tell me, you have 10 million. Why would you invest in any other thing other than this? Just tell me. Especially when you are dealing with banks, and this is my last thing. Sorry you gave me the mic to talk about investments, but I assure you this is the last thing I'm saying. Local banks, when you are evaluating banks, also use something called price to book value. You'll get some things there that are just obnoxiously exciting to an investor. So I'm going to redo to you now. Do stand chart. I want to show you a difference between our local banks and international banks operating in Kenya. There is something very clear on how they behave or how our market prices them. And then we can discuss about the reason why. Stand chart. Deal with Stanbic. Stanbic is a South African bank. It is a standard bank. Then my brother, deal with Equity Bank or KCB, any that you like of the two. Deal so that because Nation Media Group hosted us and their former dominant shareholder was Aga Khan, let's use DTB because it's their sister company. So all of you now, Google this from the companies that I gave you. All our banks, because beyond PE for banks, I also apply this as a tool. Price to book means there is the price of the price, meaning if I'm to buy this bank today, what is the price I would pay? That is the price. Book means what is the actual value of the bank. Actual meaning the core capital of a bank in Kenya is 1 billion. So we have a fresh new bank today. So the core capital is 1 billion. That's the book value. The price value is, yes, it's valued at 1 billion. If somebody offers to buy us, what are they offering? So if they offer anything below the 1 billion, and we accept to sell to them, it means we are selling to them at a discount. If we mean to sell to them at a higher price than 1 billion, it means we are selling to them at a premium. So if we sell to them at 1 billion, it means no premium and no discount. So the price to book will be 1. So the starting point is 1. If the price is equal to book value, then you've bought it as a fair price, no discount, no premium. Hakuna mtu ameumia. Wa kuuza ameuza vile ilikuwa. Wa kununua vile ilikuwa. So tuko sawa. So let's now check in our own markets now. The same companies that I gave you, check what's the price to book value of the companies I talked about. And they are all banks. We start with Standard Chart because we'll start with these two because they are not Kenyan. Then you see. They are Kenyan, yes, but the parent company is not Kenyan.
For Standard Chartered, the price to book ratio is 2.7.
That's AI. I think the actual one is 2. The very actual. Anyone with if you do, they actually announced a drop in profit. That's why. Maybe. It used to be 2. Who can volunteer what that means? The price to book value standard is 2. What does that mean? Somebody just Lift up your hand where you are. It is 2. What does that mean? Price, what you are buying, over what the actual value is 2. Yes? Please say your name and the company. You must be working for a very good company. Mainga, that must be your employee. How politicians do things. When they hear it was this, I knew. Yes, repeat so that we all hear, because that's the correct answer.
So what it means is that when you pay two times book value, the price you're paying in the market is twice the value of everything. If you were to sell that company, everything out, you're paying twice that value. So you find a high price to book, then you're paying a very high, it's expensive. If it is below 1, it means you're buying a discount. So Standard Chartered is looking expensive.
Premium. You use the name
It's
premium.
a premium.
Premium of what percent?
200%.
Very good. Excellent.
Stanbic Holdings PLC currently has a price to book ratio of approximately 1.36.
Tell us what you understand with that.
Putting me on the spot. Okay.
Or
essentially, I take it means that if I was to offer to buy it, I'd pay a premium.
of
Of around 30%.
36%. We have now all understood that. Now hear these ones now. Check.
I did both with KCB and equity.
Yes.
They're all at a discount. So KCB, let's say the equity is 0.85, which means the value of equity in terms of assets and what you're buying on the stock price, the assets are more than the price because you're buying at a discount. KCB has
discount of what percent?
15%.
Precisely. These are actually not assets. These are shareholders' funds.
Yeah.
You know, in a bank is an intermediary. Shareholders' funds is the money where if you give your deposits and you pay us your loans and you account for NPLs, what remains on the table? Those are the shareholders' funds. Real money. KCB.
And KCB is 0.65, so it's nearly half. It's near 35% discount.
And remember, AI is using full year, last year financials. Here, our sister company, Diamond Trust Bank.
Wow. Diamond Trust Bank. The price to book ratio is hovering between 0.36 to 0.44.
I know by the look of your eyes you think she's wrong. But it is you who is wrong. She's actually right. Anyone who volunteered to tell us what that means? A volunteer, tell us what that means. Not the people on the stage. The people, all of us. Tell us. You just took lunch.
That means you're paying 40% of the value.
Can you imagine that? So somebody would argue, why these two? Our market has a gap of information. So what do? We are totally a dividend-driven market. We don't even care anything else. A current investor in the NSC picks the dividend times 10 and gives their age. Their price is usually times 10 to 12. They close the chapter. Oh, wametulipa 10 shillings. That share should be hovering around 120 shillings. That's the reasoning of the current market. That's why these two banks, they declare more dividends. Because it's not their business to expand to DRC. It is Standard Bank of South Africa that should expand to DRC. not Stanbic Kenya. So when Oigara makes profits, he declares almost everything to everyone. Because the most expansion he can do is to open a branch within Kenya, not to go to Uganda. It is the parent company to do that. The same with Stanchart. So in terms of value, then you realize Mwangi there, Mwangi makes 75.5 billion in profits, pays us 22 billion. The rest, he goes to Mozambique to buy a bank, and then passes by Agora to buy another one. So as a shareholder then, I am positioned. I think Mwangi is using my shilling to hunt for me more money. That's why I have more inclination to these two myself. Why? If these two says today we are done with expansion, if Equity Bank paid the same dividend payout as these two, the share price should be more than double that. Just using what you've googled here in terms of P ratio. Now talk about Diamond. That there are people in Kenya sitting in a room to start a bank. They are starting at 1-to-1. Why bother? Just come and buy a bank at 40% discount. Anyway, thank you very much. I think
Session? Are we in agreement? Yes. Now, Honorable, thank you so much. Let's give him another round of applause. And of course, also appreciate Mr. Russell and a team for accepting to give us different examples. Now, we'll only take 3 questions. Is that okay? Just 3? There's one at the back. Okay. 1, 2, and the lady. So we'll start off with the lady.
Thank you so much, Mheshimiwa, for your time. My name is CPA Winfred Mbicho, and I'm honored to ask my question today. My question actually goes to all the industry players. I believe all of us, or majority of us, have some level of education, but what are we doing to ensure that the common mwananchi is getting that information to ensure that they make great investment decisions? Case example, we have seen companies like Safaricom. Everybody knows Safaricom, including the person who sells the kiosk, like the low income person, they know Safaricom, but they have never gotten tired of advertising. Anytime I switch on my TV, I'm always seeing an advertisement of Safaricom running across my TV screen. So as the pioneers, or as our leaders, what are you doing to make sure that that person has a little bit information of what is a stock, as low as what is a stock, how can I invest in the stock market, how can I buy maybe that bond instead, because I believe most of them fall into gambling because of that lack of that information. The low-income earners will say, this is the only thing that I know. If I put my 100 shilling here, I have a chance of doubling it. Okay, I also have a chance of losing it, but I also have a chance of doubling it. Why can't we have road shows where NSC is going around, even the what are they called, Vijiji, to ensure every person gets that financial literacy? That's my question for today.
I'm very delighted, Mheshimiwa. I wanted only to ask, because you are an MP, is it possible you can really create a law or a policy so that we can be able to educate our children from CBC now, introducing the issue of shares and investment, so that we can be like Americans, where the over 50% are really trained in shares? 2, Mheshimiwa, we are shareholders in KPLC together. I know you don't know me, but anyway, we'll know each other. What is the impact of opening Kenya Power? Because they are saying the EPRA is opening the issue of the power to other sectors to really compete with KPLC. And finally, Mheshimiwa, thank you for good job which you are doing for this country. I think you are really, maybe you'll be the future leaders. Thank you.
Economics at Maseno University. Ndindi is one of the figures we used to admire. And for that matter, I'll appreciate the work you do and encourage you to walk the talk. Ukibadilika, sisi pia tutakugeuzia mgongo. So on that case, I've seen discussions about debt, and there is this matter called fiscal deficit. The government doesn't speak about it. Reducing our expenditure, we spend more than we get. Kindly, as you expedite the fuel issues, expedite this as well. Let them reduce the expenses. That is the fastest way we can heal in the economy. Back to the matter at hand, that is diversification. To me, there are norms. Somebody might think that diversification is around having many assets, but then it should be having assets that respond differently to economic stress. And that brings me to my question on the microeconomic shift that in East Africa, over the next 5 to 10 years, that you think investors are currently underpricing. Thank you.